Monetary Policy Committee decided to lower the central bank CBR by 50 basis points to 10.75% from 11.25%. It also reduced the cash reserve ratio, the CRR, by 100 basis points to 3.25% from 4.25%. To complement, the economic growth has decelerated in 2024, and therefore there was scope for further easing of the monetary policy stance. There was scope for further easing of the monetary policy stance to support economic activities while ensuring that the exchange rate remained stable. The reduction in the CRR will release additional liquidity to banks, and this is expected to lower the cost of funds and lending rates and support economic growth and credit, economic growth rising from increase in credit to the private sector. The committee observed that the CBR has been lowered substantially since the MPC meeting of August 2024, yet lending rates have only declined marginally. With these measures, banks are expected to take the necessary steps to lower their lending rates further, to stimulate growth in credit to the private sector and support economic activities. To ensure that banks are implementing the risk-based credit pricing model, the central bank has embarked on on-site inspection of banks to ascertain that they are reducing their interest rates in line with the risk-based credit pricing model. Under the amendments to the Banking Act recently enacted by Parliament, any bank that has not passed on the benefits of reduced cost of funds to reduce their lending rates to the private sector will be penalized in accordance with the law. The MPC will closely monitor the impacts of the policy measures as well as developments in the global and domestic economy and stands ready to take further action as necessary in line with its mandate. The committee will meet again in April of 2025. In taking its decision, the Monetary Policy Committee looked at both the global developments as well as domestic developments. With regard to global developments and specifically with regard to inflation, the inflation rates in the major economies have declined, but core inflation rates have remained sticky, reflecting persistent services price inflation. The global food inflation has trended upward, and that can be seen in the headline inflation, particularly in the last 2 months, with an upward tick in the overall inflation. With regard to oil prices, these have moderated, although there is a risk of potential volatility rising from potential tariff increases and the continuing geopolitical tensions. However, going forward, we do expect oil prices to decline owing to an increase in supply by non-OPEC oil producers, but also OPEC plus producers are expected to start increasing production in April. At the same time, demand is muted, particularly from China, given its reduced economic growth. Again, the main risks here relate to tariff increases, but also disruptions from the ongoing conflict in the Middle East. With regard to food prices, the global food inflation has trended upward, and as of December was at 6.7, and this has primarily been driven by the edible oil prices inflation, which up to December had increased by 33.5%. Other inflation rates for sugar and also for cereals continue to be negative. Overall, global inflation is expected to decline in 2025 from 5.7 2024 to 4.2, and further to decelerate in 2026 to 3.5%. And this decline in inflation provides some headroom for further reductions in interest rates in the major economies, but at different paces depending on their inflation and growth outlooks. In terms of the global economic growth, we see some improvement from 3.2% in 2024 to 3.3% in 2025, and that growth is maintained in 2026, again at 3.3%. It's important to note that the U.S. continues to have a very resilient economy, with growth this year expected to be at 2.7% compared to 2.8% last year. We're also seeing some recovery in the United Kingdom and also Japan. And in terms of the emerging market and developing economies, China continues to have some difficulties. The growth is expected to decelerate to 4.6% this year, and further to 4.5% in 2026. India's growth continues to be very strong. Last year was estimated at 6.5%, and it is expected to sustain that growth in 2025, but also in 2026. The stronger growth outlooks in the US, Saudi Arabia, and UK in 2025 do provide scope for higher diaspora remittances, inflows, and also tourist arrivals to Kenya. And the projected pickup in growth for the Euro area and sub-Saharan Africa in 2025 should benefit Kenya's exports to Europe and also to Africa. So to summarize global developments, the global headline inflation has moderated, but the pace of decline has slowed down in major economies due to the stickiness in core inflation. Central banks in major economies have continued to lower their interest rates, but at different paces depending on their inflation and growth outlooks. This should improve global financial conditions and market access for emerging markets. The global growth is projected to improve to 3.3% in 2025 from an estimate of 3.2% in 2024, supported by strong growth in the United States and India, and improved prospects in the growth in the United Kingdom. Risks to the global growth outlook relate to elevated uncertainty on trade policy, amid rising tariffs on imports and further escalation of geopolitical tensions, particularly the conflict in the Middle East and between Russia and Ukraine. Kenya's real GDP growth is expected to remain above the global, the sub-Saharan Africa, and emerging market and developing economies averages both in 2025 and in 2026. Turning to macroeconomic developments, the domestic macroeconomic developments, the core and non-core measures of inflation for Kenya, jointly developed by the Kenya National Bureau of Statistics and the Central Bank of Kenya, were launched last month, January 2025. Core inflation excludes products whose prices are highly volatile and transient, and therefore provides a more comprehensive measure of the underlying trend of inflation. In addition to overall inflation, the CBK will keep track of the core and non-core measures of inflation in line with global best practices in inflation targeting central banks. The introduction of core and non-core inflation measures also aligns with the East African Community guidelines on the computation of harmonized CPI in the region. The total core CPI basket comprises of 275 items with a total weight of 81.1% in the overall CPI, and is therefore a more representative basket and closely tracks the overall rate of inflation. So domestic inflation remained below the midpoint of the target range of 5 plus or minus 2.5% in January 2025, and this was supported by lower core inflation. Core inflation declined from 2.2% to 2%, and what increased the overall inflation from 3% to 3.3% was a pickup in non-core inflation from 5.2% to 7.1%. In terms of the contribution to overall inflation, as you can see from the right-hand panel, the core inflation has remained relatively stable. Its contribution has remained broadly unchanged since around October. And what has been driving the increase in overall inflation has actually been the non-core inflation. And for example, between December and January, core inflation, its contribution remained at 2 percentage points, but non-core inflation increased from 1 percentage point to 1.3 percentage points. With regard to core inflation, the decline in core inflation was mainly on account of lower prices of processed food and also alcoholic beverages. For the so those are the two key, and you can see the decline from 2.2 to in December to 2%. You can see there at the bottom the main drivers for that reduction were the processed food items that declined from their share declined from 0.2 to 0.1, and similarly for alcoholic beverages, a reduction from 0.3 to 0.2. With regard to non-core inflation, the main drivers are food crops and related items. These were the ones that mainly drove the higher non-core inflation. And within the non-core inflation, what really has driven the increase from 5.2% in December to 7.1% in January were the food crops and related items. And you can see there that the percentage, the contribution for the food crops increased from 5.9 to 8.2%, compared to the energy, fuel, and utilities, whose contribution actually was negative, was an increase negative from minus 1.3 to minus 1.8, and the transport contribution was only 0.7 percentage points. In terms of expectations looking forward, we did have an agricultural survey in January 2025, and most of the respondents to this survey expect some moderate upward pressure on overall inflation in the next 3 months on account of higher vegetables and cereals prices attributed to seasonal factors. Nevertheless, the respondents expect stability in palm prices, but also in the stability of the exchange rate. Our forecast for overall inflation going forward, we expect that even by June, the overall inflation will be below 4%, and therefore still below the midpoint of our target range. To summarize these developments on inflation outlook, the overall inflation remained below the midpoint of the 5 plus minus 2.5% in January 2025. The inflation rate increased in January 2025 mainly on account of a rise in non-core inflation due to seasonal factors. Core inflation remained low and stable, indicative of muted demand pressures, and the exchange rate stability has reduced imported inflation. Overall inflation is expected to remain below the midpoint of 5 plus minus 2.5% target range in the near term, and this will be supported by a low and stable core inflation, expected easing of energy prices, and a stable exchange rate. And the main risk to the inflation outlook relate to uncertainties in the evolution of international oil prices and the uncertainty of global geopolitical environment. Turning to the domestic economic performance and outlook, we have had to revise the growth for GDP in 2024 from the previous estimate of 5.1 to 4.6. Our estimate of agriculture continues to be strong both in 2024 and also in 2025, supported by favorable weather conditions, but also government programs such as the subsidizing of fertilizer. However, we see some challenges in the industrial sector. In 2024, for the first time in a very long time, we saw contraction in the construction sector in the second quarter and also in the third quarter. And therefore, we expect the industrial sector in 2024 to only grow by 0.4, just a very small increase. The services sector also slowed down in the first three quarters of the year compared to the year before, and therefore we are projecting services growth to be about 5.8%, and this is compared to 7% in the previous year of 2023 and also 2022. We also expect that the high interest rates during the course of the year did contribute to reduce credit to the private sector, and this also suppressed domestic production. And the combination of all these factors led us to revise the GDP growth to 4.6% in 2024. However, in 2025, we do expect a recovery, and growth we are projecting at 5.4%. And this is premised on continued resilience in agricultural production at 4.9% and a recovery in industry. And specifically, we expect a recovery in the construction sector to grow by 4.7% and also the services sector to increase from the 5.8% of last year to 6.3%. And this again is informed by the fact that we expect interest rates, commercial bank interest rates, to come down, and that should offer incentives for increased demand of credit by the private sector, and that should ultimately stimulate economic production, and the services sector should therefore do better this year than it did last year, when real interest rates were so high. Of course, we also expect the lower interest rates to stimulate construction in the private sector, and also we do expect now that the government will be able to spend more on development projects, and that's why we have projected some recovery in the construction sector. This is a demonstration of what happened to credit to the private sector in some of the key sectors. And you can see in the manufacturing sector, credit from the banks declined from an increase of 23% in December of 2023. And there was a continuous decline in expansion of credit to the manufacturing sector, and appears to have reached negative 14.3% before some recovery, although it's still negative by December of 2024. This again reflects both the appreciation of the exchange rate, the shilling exchange rate vis-a-vis the US dollar. Some of the loans to the manufacturing sector are denominated in foreign currency, and so the appreciation of the shilling also is reflected in this reduction in credit to the manufacturing sector. Similarly, you can see the transport and communication. Again, credit going there has been on a downward trend. as has been to the building and construction sector and also to the trade sector. So to summarize developments on with regard to domestic economic growth, the performance of the economy slowed in 2024 third quarter, with real GDP growth decelerating to 4% in compared to 6% in the third quarter of 2023, mainly reflecting a slowdown across most of the sectors. Real GDP growth for 2024 is driven by resilience of select sectors, a stable growth of the agricultural sector, expected recovery in growth of credit to the private sector, and improved exports growth supported by implementation of trade initiatives such as the Kenya-EU Economic Partnership Agreement. The outlook is subject to uncertainties in the external and domestic environment, including the rising tariffs on trade and persistent geopolitical conflicts, which could have potential impact on supply chains. Turning to monetary developments, growth in broad money supply moderated on account of the exchange rate valuation effect attributed to appreciation of the shilling. So growth in M3 as of December was actually a negative minus 0.2. And that, of course, includes the exchange rate valuation effects. When we adjust for the exchange rate valuation effects, the growth was actually 5.2%. But of course, still, even after we have adjusted for the exchange rate valuation effects, there is a downward trend in expansion of M3. When we just look at M2, that is excluding foreign currency denominated deposits, we do see that there has been a recovery in expansion of M2, where by November it had increased by 7%, and by December it increased again to 7.1%. Looking at the growth in credit to the private sector, without including the exchange rate effects, we see that there's a contraction by December of minus 1.4%. But if we adjust for the exchange rate valuation effects, the credit to the private sector grew by 3.1%, which is slightly higher than the growth that was experienced in November of 2024. Again, this is just a disaggregation of the credit to the private sector by currency. When we just look at the credit to the private sector denominated in foreign currency, we see that by December that had contracted by 11.4%, whereas the local currency loans had increased by 2.1%. And of course, now when you combine both the local currency loans and foreign currency denominated loans, you get that contraction of minus 1.4% in December. The short-term interest rates have declined further in line with the lowering of the CBR. And you can see that the 91-day Treasury bill, the 182 Treasury bill, and the 364 peaked at some point in around July and have all been coming down. The 91-day Treasury bill has actually declined from 15.8% to the current rate of 9.6%. Similarly, the 182 Treasury bill has also declined from almost 17% to about 10%. And then finally, the 364 Treasury bill has also declined from almost 17% to the current level of 11.3%. In terms of the commercial banks lending rates continue to increase through November and declined marginally in December of 2024. Here what we have is showing the average commercial bank lending rates at 17.2 in November, which then declined to 16.9% in December. We have also included the developments in overall inflation, and as you can see, the real interest rates, which basically is taking the nominal lending rate of commercial banks and deflating it or reducing it by the overall inflation, and that is the blue line that you can see has been going up for quite some time, and reached a peak of 14% in real terms, and then declined to 13.5%. And obviously, real interest rates at this level are very high, and very few businesses can really operate on this kind of high real interest rates. And that's why we have been pushing for the banks to lower their lending rates and specifically their real interest rates, so as to stimulate credit to the private sector. On the monetary policy implementation framework, the interbank rate continues to track very closely the CBR, and this has improved the monetary policy transmission to the short term through the short-term interest rates. To summarize the monetary developments, growth in money supply, in broad money supply, M3, moderated in December of 2024, mainly reflecting contraction in credit to the private sector, but also the exchange rate valuation effects. The growth of credit to private sector across most sectors has slowed down, reflecting the impact of the exchange rate appreciation on foreign currency loans, but also the high lending rates due to the lag effects of previous tightening of monetary policy, but also the slow reduction in the lending rates to the private sector. There has been the banks have not moved as quickly as to lower their rates as other rates, whether it is the TBO rates that we've seen that have reduced quite significantly and very quickly, and also the CBR, which has also reduced quite significantly. We have not seen the lending rates by commercial banks declining substantially. The short-term interest rates, particularly the interbank rate and the 91-day Treasury bill rates, have declined in line with the reduction in the CBR. And as I said, the commercial banks' average lending rates declined only marginally in December 2024. The lowering of the CBR and the reduction in the CRR from the Monetary Policy Committee meeting yesterday are expected to lower lending rates and support lending to the private sector in 2025.